you touch on many different things, but there's a thread that connects them all. Japan, China as well, the global financial crisis, and this phenomenon in the US in the 80s of bloated companies. And you said that there's the assumption that managers know best, let's just keep the shareholders aside. Yeah. And then that was identified as a problem.
Yes.
And it's basically the agency problem.
That's right.
Isn't it?
That's right.
And you know personally some of the academics who are synonymous with these discoveries. Do you want to talk a little bit about
if my book has a hero, it's Michael Jensen, who got his start at the University of Rochester. He wrote the most cited article in academic finance. It's about 150,000 cites. It's called Theory of the Firm, Agency Costs, and Ownership Structure. I'm mangling the title here. But the paper argued that there is a very large tension between the goals of corporate management and their shareholders. Managers have an excessive preference for growth, size, and diversification. You know, it just basically makes their jobs, it increases their prestige. It reduces the need for drastic layoffs at any one time, and so but for investors, they can diversify their own portfolio, so they don't need this kind of risk management device, and they want high rates of return on capital. And they want companies to invest as much as they can in their growth opportunities, but they want to pull the money out of their failing companies as quickly as possible. And conglomerates just don't do that. Conglomerates tend to starve their growth opportunities in order to maintain their failing businesses. And this ends up being a disservice to everybody involved. The shareholders end up losing. The companies end up having to lay off people. My favorite case is Volkswagen. This is the largest German private sector employer. It's 20% owned by the government of Saxony, but they have never had a factory closing in 100 years. And they recently announced that they're talking about laying off 10% of their workers, and the workers who remain will also have to take a 10% pay cut. This was their first bid in a round of negotiations with their labor. Whereas if you compare that to GM about a month earlier, GM basically ended up giving its workforce 30% raises over the next 3 years. But GM has already gone through horrendous downsizing as well as a bankruptcy. It's the only company that failed to repay the government money to prop it up after the global financial crisis.
What's the lesson from Volkswagen, though?
Their goal is clearly full employment. The German system works on co-determination, which basically means that labor has a half a voice or one vote for every vote of shareholders. But the pursuit of full employment and market share ends up leading to a bloated company which can't compete. And once China started to pull the rug out under Volkswagen, the company is just losing value, and it's now been forced into a desperate situation where they're going to need new funding. It's the same. It's a failure of corporate governance.
Yeah. So it's the same in Japan in from the 80s onwards.
That's right.
But do you want to explain why that's the case? What was the Japanese corporate agenda then, if it wasn't profitability of the business?
It's continuous growth. And it's full employment, and it also and companies are not allowed to pay out excess cash. The share repurchase was actually illegal until 1997. The Japanese sent a deputation over to Stern Stewart. They talked to me about whether or not stock repurchase was a good idea. And I said, the problem with the Japanese economy is the capital is trapped inside the firm and has no way to get out. So managers are just going to waste it. They'll waste it on increases in market share where there's just already overcapacity. They will do diversifying acquisitions. They will just find ways to preserve growth and employment, which end up hurting everybody involved. And the interesting thing is I don't know if you saw this, but the Financial Times ran an article at the beginning of January saying that the spokesman for the Japanese Kaidan Ren, which is the business roundtable of Japan, has now reached the realization that American shareholder activists could hold the key to a revival of the Japanese economy. The spokesman for the Kaidan Ren said, "We have been in a 30-year slumber," he described the Japanese economy, "and we are inviting the Elliott managements of the world and the KKRs to come over and help us make our companies more efficient." And my argument is that this is a prescription for growth. It will cause some temporary pain and some firings, but this is going to allow for it will invite foreign capital. Warren Buffett is already beginning to invest big time in Japan. He saw some of this coming, so he's ahead of the wave. But he's investing in conglomerates. But the role of the American activist will be to come over and introduce financial discipline to companies that have been lacking it for 30 years.